Hi, I'm Jimmy. In this video, we're looking at what have been the best performing dividend stocks through some of the biggest stock market crashes in recent years. We're going to look at the COVID crash of 2020, the financial stock market crash back in 2008, 2009, and then the tech bubble at the turn of the 99 to 2000. And hopefully we can identify a few dividend stocks that have consistently performed well throughout different stock market crashes, and hopefully we can decide whether or not these could be a good additions to our portfolio, because ideally we're going to get decent performance and we get to go ahead and collect dividends. Now, because it can be tricky to come up with a total return for all publicly traded stocks, I'm actually limiting our field of potential companies to the S&P 500 companies. So which companies pay dividends out of the S&P 500, and then which ones have performed the best during the different market crashes. Okay, so this is a chart of the S&P 500 during the COVID crash of 2020. I went from the high point right before the stock market pulled back down to the low. During this time period, the stock market fell. The S&P 500 fell by about 34%. So it was a decent drop in a very short period of time. Okay, then we switch over to the financial crisis. Clearly, this one took a little bit longer. This is back in 2009. But once again, the stock market did fairly poorly during this time. The stock market, from top to bottom, was down about 55%. So it got more than cut in half. And then this is what the S&P 500 looked like during the tech bubble, from again, top to bottom. During the tech bubble, the S&P 500 fell by about 27%. Now, if we were looking at the NASDAQ back at that time, that fell much worse, but the S&P 500 was down about 27%. Okay, now let's see what dividend stocks perform the best during each of these time periods. So these are the top 10 performing dividend stocks from the S&P 500 during the tech bubble from during 1999 and into 2000. And we can see that, considering that the stock market during that time was down about 27%, well, these stocks did fairly well. And I think a lot of that, for this particular example, has a lot to do with the fact that that stock market crash was a tech bubble. So technology stocks ran up, and then those were primarily the ones that crashed. So outside of that, a lot of companies did fairly well. Now, on this list, there are some companies that we might expect. Companies like Hershey or Altria or Union Pacific. Those are companies that you might expect to see that would continue to do well through most economic environments. Maybe not Union Pacific, but they're pretty long-standing company. If we look at the top one here, well, the top one, this is a real estate investment trust, or REIT for short, and generally, real estate does fairly well. Of course, not up until the financial crisis, but that's a different story. So with that being said, let's now switch over to the financial crisis. So these are the top 10 companies from both the financial crisis and the COVID crash. Now, I've colored the companies that are on both top 10 lists because I think those are the more interesting ones. Can we find companies that consistently do well? So I think this is a logical place to start. So this is what the S&P 500 did during the financial crisis. We already saw this. And like we said, the stock market during that time was down about 55%. And over that exact same time period, when we add Walmart to this chart, well, we can see that Walmart started around $45 per share. And despite some volatility, it ended near about $50 per share. So over the time period where the stock market was down 55%, Walmart posted a positive 12%. Now, for all of the math people out there, you might look at this and say, how does a stock that is slightly above 45 and started slightly above 45 and ended slightly below 50 end up with 12%? It looks closer to 10, maybe 11%. And the reason for that is that I'm using total returns. So throughout this stock market crash, we would have collected these dividends through this entire time period. Total return assumes we take those dividends and reinvest them back into the stock. So it helps our performance a little bit. Now, we did the same thing with the S&P 500 here. Any dividends that would have been collected from the S&P 500 are assumed to go back into the investment. So the price return on these would actually be a bit lower for even the stock market. Okay, so Walmart looks interesting. We'll come back to this one in a minute. But sticking with the financial crisis, well, the other two stocks that were on both lists was Newmont and General Mills. And I'm not sure that these hold up quite as well. So Newmont, by the way, Newmont is a mining company. It's Newmont Mining. They mine for things like gold, silver, copper, zinc, and lead. So when we look at their chart, well, we can see that they sort of did what the market did. They just recovered a little bit sooner. So I'm not sure the fact that they were on this list, yes, they did better. And broadly speaking, we would expect gold to do fairly well. So I'm not too surprised that they, at the end of the day, recovered faster. But again, I'm not sure they did as well as something like Walmart did. Okay, then we shift over to General Mills. This is what the General Mills chart looked like. And General Mills, for those who are not familiar with them, well, they make packaged consumer foods, a lot of cereals, things like that. But this chart we can see is once again very volatile, and they ended up down about 11% during the stock market crash. Although the stock market, again, down big, so down 11 isn't quite as bad, which is always good. It's always good to beat the stock market. And we should also point out that General Mills is one of those companies that we would expect to be on this list. Generally, this is a defensive, General Mills or companies like it are defensive companies. It's a defensive industry. People usually keep buying food. So I'm not too surprised to see that they would be on this list. But let's look at the stocks that performed the best during the financial crisis, or the dividend-paying stocks that performed the best. So first we have Ross Stores. During this time period, Ross Stores was up about 12%, which was one of the best from a total return basis. Now, if we're not sure what Ross Stores is, well, they're a discount retailer, sort of like a TJ Maxx. So if we were looking for discounted clothes, well, that would be a place we would go to buy them. So again, I wouldn't be too surprised that a company like this, or even a company like Walmart, would do fairly well. During a stock market crash, during a recession, a lot of people look to save money. These types of companies tend to do well when that happens. Now, if we're curious, Ross Stores actually didn't do all that well during the most recent COVID crash of 2020. So this is the S&P 500 during the COVID stock market crash. And during this time, the stock market was down about 34%. Again, it happened really quickly. But when we add Ross Stores here, well, Ross Stores was down about 49%. And I'm now realizing that we might not be able to tell that because of the way that I have the charts scaled. They're not scaled equally. So for this one chart, let's switch over to a normalized chart of Ross Stores and the S&P 500. All a normalized chart does is it starts both companies, or in this case, the S&P 500 and Ross Stores, starts them both at 0. And then as the two move, you track their percentage return so you can see the difference. It's tougher to tell when you start them at real numbers, but different real numbers. So here we can see that Ross Stores was significantly worse than the S&P 500 during the stock market crash, at least during the COVID stock market crash. And I think the reasons are probably obvious. With COVID happening in the way that it happened, with so many brick and mortar stores being closed down, well, it's logical that Ross Stores would not do that well. Now, how will it do in the coming years could be very different. It might even have a very strong recovery as everything begins to open up. I'm actually a big fan of Ross Stores. I researched Ross Stores a few years ago. I haven't researched it in the past few years, but last time I did, I thought it was quite a good stock. So I think it would be interesting to do a deeper dive on them. Please let me know in the comments below if you think we should. Okay, so now for the leaders of the COVID crash by the top performing dividend stocks, well, the top one was Domino's. And I actually chuckled when I saw this one because, yes, this actually makes a lot of sense that with everybody stuck at home, there would be a lot of people ordering pizza. You know, I just chuckled at it because that's not typically the type of thing you would see with the stock market crash. COVID was very unusual in that way. Now, we can see when we look at the chart that they actually had a huge jump early on, which I think is very typical for the stock market, a huge overreaction early on, and then they gradually gave it all back throughout the year. And then in the latter half of the time period, there was another jump again. So again, I wouldn't expect Domino's to consistently be there, so I'm not sure this one makes a lot of sense to pay a ton of attention to. But two others that did quite well that actually I think belong in this type of list is first Kroger. So this is Kroger. Kroger's a grocery store chain, and during the COVID crash, they were up 5%, while the stock market tumbled 34%. So again, that's quite good. And they actually did decent during the financial crisis as well. The financial crisis, the stock market was down about 55%, and I think Kroger was down about half that. So yes, they were still down, but beating the stock by cutting the losses by half is pretty good. I always like beating the stock market if we can. And then we have Clorox. Clorox was up about 3% during the most recent stock market crash. Now, we might look at this and say, well, of course, Clorox did well during COVID. After all, people were all going nuts, washing their hands and buying Clorox type products, cleaning products that are meant to disinfect. But Clorox and companies like them tend to be fairly defensive companies. They tend to do well during a lot of stock market crashes. Even during the financial crisis, Clorox was in the top 30 best performing dividend stocks during that time period. So again, they tend to do fairly well, and I would expect them to be on lists like this in the future. Now, of course, we don't know where the next stock market crash is coming from, but I think mixing in some defensive stocks like the ones that we've looked at into our investment portfolio could be very solid dividend stocks to add to our portfolio to help round off it just in case there is another stock market crash, which there will be at some point. Now, if you really like dividend stocks, well, I actually did a video where I walked through how dividends really work, how a dividend ultimately affects the price, the underlying price of a stock, and ultimately which dividend strategies work really well and which ones not so much. So if you're curious to learn more about dividend stocks, perhaps that's a good next video for you to watch. I got a link right here. I've got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.